Hi, I'm Adrian Helfert, Director of Multi-Asset Portfolios at Westwood Holdings Group. Well, we've captured a lot of the volatility over the course of this month just from the fact that interest rates are down again, yet unlike the first half of the year, risk assets are also down, indicating there's a concern around the growth impact of trade policy that's currently happening, as well as the fact that we've got heightened volatility from lack of economic growth, various things. Maybe most indicative of this is the fact that real rates as well are down. Those are interest rates ex-inflation. They're down 30 basis points. That's matched with about economic growth being down. And maybe just as a microcosm, look at commodities where copper is down 7%, oil is down another 5%, and gold is up. These are growth assets combined with the concern around a systematic downturn that we might have. Well, it seems anyone's guess, but what I would say is I don't see this as a near-term or even a medium-term solution. And even upon a solution, I think investors at this point will question the longevity and the finality of what the solution is for some period of time. The positive is that what I don't see in the economy right now is these late-stage excesses that we often see build up. Thus, I do think that this external growth policy, that trade policy uncertainty, is maybe less likely to induce a full-blown recession than in the past. What it will be predicated on is if we see global conditions downturn, if we see a trade-induced recession globally, that could impact markets much more or put us in a more precarious position than we have been in the past. Well, globally, we still do not see growth, so that is a concern. Just as a microcosm, Germany recently has seen upheaval in the auto industry and then trade policy-induced downturn, which is leading them closer to recession, certainly a downturn in growth, where they may have to add fiscal responsibility or fiscal stimulus in order to stimulate their economy. These are conversations at the G7 as well as variations in currency differentials. So we do worry about that. We see lack of growth there that could cause more downturn in the global economy. The U.S. Treasury yield curve has shown 6 out of the last 7 recessions, for certain, that it precedes, when it goes below 0, it precedes a recession. So what is it? We look at the 10-year yield minus the 2-year yield. Why is that important? Because the 10-year yield is often an indicator of economic growth. So when economic growth goes down, the yield goes down. The 2-year yield may come up, which is pushing on the far end of the curve, pushing down growth, in which case you have a flattening yield curve. The 2-year yield right now is around 152, with the 10-year yield around 150. Thus you have a negative yield curve. That's concerning for markets. You have policy in the front end that is higher than in the 10-year section of the curve. I think that external growth stresses as well as global negative yields across economies are impacting the yield curve inordinately. So there's something we need to take into account there. We need to see it tick negative for longer than just the short period we have to take a good indication, but it is a concerning factor that we look at. But this recession or this forthcoming cycle downturn, if we see one shortly, I think it will be shallower if we are where we are now, which is, as I spoke about earlier, there's lower excesses in the economy at present than we've seen in prior down cycles. Thus, if we do see a down cycle, a recession condition, it's not going to be the big drawdown that we saw in 2007, 2008. It's going to look a little more flattened. Just to wrap it up, we're seeing a slow and low growth economy like we've seen for the last 10 years. It's not heightened. We're seeing heightened volatility as we see concerns around yields as well as trade policy impact. Yet at the same time, we don't see the heightened excesses. We do see this elongated, we see capacity for growth. Thus, we'll keep an eye on it. Certainly there are red flags that we'll watch and communicate to our investors. We appreciate your time, and I look forward to speaking with you next month.